Okay, so I'm going to talk about a couple of examples from Chapter 14 where we can use our amortization table not only to talk about interest and amortization for bonds, but also for notes payable. So real quickly, a note payable is really a note is an arrangement between a borrower and a lender, and it's really a one-to-one kind of relationship. Bonds, you'll remember, are sort of offered to the general bond market, and lots of people can participate, and the company doesn't really have a direct relationship with individual bondholders. Well, with a note payable relationship, it's different. The company and the lender are sort of one-to-one parties. They're interacting directly with each other. Normally, a note payable is not a big deal from an accounting standpoint. We debit the cash that we get when we borrow, or we debit the asset that we purchase. We credit notes payable, and then as we make our interest payments, we debit interest expense, we credit interest payable or cash if we're making the payments, and at the end of it, we reverse the original entry, we debit notes payable, credit cash. There are a couple scenarios where the normal notes payable accounting doesn't really make sense. And those are the examples when we have either a zero interest bearing note or a note with an unreasonably low interest rate. So what kind of scenarios would we see something like that happen? So let me give you a couple of examples. Here we see in a consumer product sort of setting, we have this company called Sleep Number that is, you may know them, that they make the beds, the inflatable beds, so that you choose how firm or soft your bed is. Their mattresses are actually pretty expensive. They're thousands of dollars. So in order to encourage people to buy them, they offer financing. And so here they have a special offer, 0% interest for 36 months. Now, you and I know that no one but your grandma is going to loan you money at 0% interest. Sleep Number is not really loaning you money at 0% interest. Instead, what they've done is they've built the purchase price, or they built the interest into the purchase price of the product. And so when they give you 0% interest, really what they means is they're not charging you any interest on top of the purchase price, but in real life, it's not 0%. As accountants, we need to recognize that and sort of see through this and impute a regular or a reasonable interest rate instead of 0%. So sometimes you'll get a note that on paper doesn't have any interest. Or sometimes you'll see something like this where it's not really a 0% interest, but it's a very low interest rate. So here's Toyota, and they want to clear out their inventory of 2019 Corollas because they want to start selling 2020 Corollas. And so in order to get their Corollas off the lot, they offer you what looks like a really, really good deal on low interest rate financing, 0.9%. Now, even though interest rates are pretty low these days, 0.9% is lower than a real regular interest rate. So again, they've built some interest into the purchase price of the car, and they charge you what looks like a really low interest rate. Again, as accountants, we need to apply the matching principle. So we want appropriate rates of interest to be recorded on our debt. So how can we do that? Well, if you think about what bonds are a setting where you've got an amount of money being borrowed, you've got a stated or a face or a coupon interest rate, and then you've got the actual interest rate is something different. In this case, a note payable can work kind of the same way. You've got a stated interest rate for exercise 1416, a stated interest rate of 0%, or in this case, maybe 6%, but the company's interest rate is really 11%. So we have the same kind of setting where we've got a face rate and an actual rate that are not the same. How are we going to go ahead and account for these? Well, I'll do part one in this video. Part two will be the next video. On January 1st, 2017, Ellen Carter Company makes two following acquisitions. The first thing they did is they purchased land having a fair value of $200,000 by issuing a 5-year, zero interest-bearing note in the face amount of $337,012. The company normally has to pay 11% interest. We're going to record the journal entries that should be recorded for the purchase and then interest at year end using the effective interest method. So let's take this first thing. we purchased land having a fair value of $200,000. In 5 years, we're going to make a lump sum payment of $337,012. So where does this number come from? Well, what this number comes from is if we take our present value tables, we can calculate the relationship between the 200,000 and the 337. So our face or maturity amount is the 337,012. What's the present value factor for this face amount? If we go to our present value tables, we're told the company has to pay 11% on its borrowings, and this is a 5-year note. And so if we take 11% in 5 years, our present value factor is 0.59345. So if we go back to our 337,012, and we price that back to today, so within rounding error, that's $200,000. So what we're saying is that $200,000 today, if it grows at 11% for 5 years, that $200,000 grows to $337,012. And that is how we get the price of the bond. Now, or the price of the note. So how are we going to record this? Well, we know, if you go back to chapter 10, how to record the value of land. We record it at the fair value of what was given up or what was gotten, whichever is more readily determinable. Well, in this case, the land is $200,000. The fair value of the note is $200,000. So easy to figure out the value of the land is $200,000. We also have the note payable, which, as we always do with the note payable, we record it at its face value, just like we would with the bond, and then just like we would with the bond, we have a discount on notes payable. That's the difference. So here our note is recorded just like a bond. Face value is the debit to notes payable. The asset value is what's debited, and then the plug figure is a discount. So this is our first journal entry on January 1st. Now, how are we going to record interest on this? What interest rate are we going to use? Are we going to use 0% interest? Are we going to use 11% interest? How are we going to record it? Well, if you'll notice, we discounted at 11%. And for $200,000 to grow to $337,000, that's effectively recording 11% interest. So how are we going to reconcile the fact that we have 11% interest with the fact that we've got a 0 interest-bearing note, which means we're not making any interest payments? Well, just like with a bond, we use our amortization table to calculate the difference between the interest payment and the interest expense. And the difference between those two is the amortization, and that's going to change our carrying value. Why did that turn up yellow? I got no idea. So our initial carrying value is going to be $200,000, and that's 1,117. As we spread this guy out for the next 5 years, 18, 19, 20, 21, 22, what do we know about this? We know our interest payment is 0% because we have a 0% note. So just for completeness, I'm going to take our prior carrying value times 0%. We're going to click and drag. And all of our interest payments are going to be 0. Now, what's our actual interest expense? Well, just like with a bond, our interest expense is going to be based on the effective interest rate that we want to record as the right amount of interest for the liability on our balance sheet. So since we know that our actual interest rate is going to be 11%, we're going to record interest expense at 11% of the prior carrying value. So 11% times our prior carrying value. Now, What's amortization? Amortization is always the difference between the interest expense and the interest payment. So in this case, it's pretty obvious. I'll take all my decimal places out here. Fine. There we go. In this case, it's obvious that 22,000 minus 0 is 22,000. Now, is this going to increase or decrease our carrying value? Well, we've got a discount. We're making the discount go away. And so to make the discount go away, we move our carrying value up. If we click and drag all this down, yeah, of course, we've got $1 of rounding difference, but that's not a big deal. What we do is we figure out that every period we record 11% of the prior carrying value. That number keeps going up every period because the carrying value keeps going up. As we amortize that difference, we increase the carrying value and we bring our carrying value up to 337,011, 337,012. Again, that's $1 of rounding difference, no big deal. So just like always, this gives us our journal entry. The amortization table, the magic amortization table, gives us our journal entry. So on 1/1/18, we would record our first, well, I guess on 12/31/17, we'd record our adjusting journal entry. We're going to record interest expense of $22,000, and we're going to reduce our discount by the same $22,000. And every period after that, we're going to do that. We're going to make this same journal entry. So at the end of every year, we're going to amortize whatever this line item is. This is going to be our expense, it's our amortization. Notice there's no cash payment because it's zero payment, or it's zero interest. But what we're going to see with our T account is we start with a discount of $137,012, and then over the life of the note, we're going to amortize all of these. We're going to amortize the discount away. Sorry, I'm talking and typing at the same time. And if we take this minus the sum of these guys, we'll get within rounding error, yeah, we'll make our discount go away. So it's 53 cents off. Please forgive me on that. But you see what's going on here. This is the same way a bond works. Just because we call it a note payable instead of a bond payable doesn't mean the interest actually works differently. The interest works exactly the same. So every period, this is going to be our journal entry, expense and discount, and that's how we're going to record things. So the journal entry that should be recorded when we make the purchase, debit the land, credit note payable for the face, discount is the plug. Interest at the end of the first year is going to be the 12/31/17 adjusting journal entry is to take these guys. Works the same way as a bond payable amortization table. I'll go ahead and stop there, and part 2 of the problem we'll do in a second video.